Hello everybody, welcome to another video on the channel, and today we are going to get into the serious stuff in accounting, and this is where actually it starts getting harder if you don't actually understand this part. So remember, if you've watched the previous video, which is about assets, liabilities, owner's equity, and most specifically the accounting equation. Now, if you understand that, this is going to be more understandable because it's all building upon each other. And there are so many things in accounting where you just have to learn it off by heart, like, okay, this is how we're supposed to do it, that's how we do it. And this is unfortunately one of the stuff where we're going to understand how double entry system works, how T account works, and what debit and credit is actually. And it's very tough to understand, so let alone teaching it. Right, let's start. So these are the chapters we're going through: the principle of double entry, debit versus credit, and then we're gonna go through 3 examples, because the thing about this topic specifically is that everything else is connected to this topic. All right, and to only understand how the double entry system works, you have to do more and more practice. All right, so the principles of double entry. Now, I know it kind of sounds like I'm reading off the slide, but don't worry, after reading every single sentence, I'm actually going to explain it. So, the double entry system is a fundamental accounting principle where every transaction affects at least 2 accounts, maintaining the accounting equation. So, as we see here, assets must always equal liabilities plus equity, right? Now, if we are going to debit one side of an account that is an asset account, then there must be a change happening in one of the liabilities or equity account to keep this equation balanced. All right, so this is the whole point. That's why we call it the double entry system, because once one account is affected, another account must be affected. So it's always like 2 accounts at the same time. You can't just say, okay, I bought like some new equipment for the company and then I just debit the office equipment. Right? Now I know that does not make sense in the beginning, but you can't just do that, because that means you are gaining an asset, but you've definitely lost something, right, to get that asset. So you have to show it. This is, as I said, it's a bit difficult to grasp that, but with more practice, hopefully, you will understand. And then, so we've got each transaction has a debit and a credit of equal value. This ensures that the books remain balanced. Alright, and that's the main reason why in accounting you always hear about balancing accounts, stuff like this. It's always about that, right? It's because when you are trying to account for every transaction happening in the business, you have to make sure we do that to make sure that there are no errors. We know exactly what's happening in the company and we prevent fraud. It enables accurate financial reporting so that we can be able to create financial statements like income statements. This is the whole point of it, indeed. And then we've got forms the basis of the trial balance and financial statement. So the trial balance is actually very fun. We will go through it in another video. It used to be my favorite one when I had to learn it at school. So I can't wait to teach about the trial balance. Alright, so now we're getting into the serious stuff, debit versus credit. Now we talked about T accounts, and what T accounts are usually is just like a table with just 2 sides, and usually your debit side is on the left and your credit side is on your right. Okay, now how do we know if we are debiting or crediting an account? Now there is rules, and simply you just have to follow these rules without any ifs or buts. Okay, this is how it was built, this is how the system was built, and what we say is that any debit, so any account that is debited usually is an entry recorded on the left hand side of a ledger account. And if you don't know what a ledger account is, I've mentioned it and I've explained what exactly it does in one of my previous videos, and that reflects an increase in an asset, expense, or dividends, which is something we will be learning about later in the future. Or it could also mean a decrease in liabilities, equity, or income. Now, what about the credit? It's just the exact opposite. It is recorded on the right hand side of a ledger account, or a T account, some people call, that reflects an increase in liabilities, equity, or income, right? So it's, except it decreases assets, expenses, and dividends. So exactly the opposite. And to remember this whole thing, we use a mnemonic called dealer, as you see. So if we had DEA here in the debit side and LER here in the credit side, each one has 3 letters, so you can just divide 6-lettered word into 2. And then DEA, so in dealer, you've got D for dividends, E for expenses, A for assets. And LER in dealer, which is in the credit side, any of the, so L for liabilities, E for equity, R for revenue. And obviously this is only if one of these increase. What if it decreases? It goes to the opposite side. So if we say dividends or expenses decrease, we actually credit them. What if liabilities decrease? We actually debit it. So if expenses decrease, we credit it, but if it increases, it's always debited. All right, I hope that makes sense, but don't worry, I've got your back. I know how difficult this is, so I've created 3 examples to understand this deeply, and I'll be creating more videos in the future so that I give more examples so you kind of get the grasp of it more and more, because it's very difficult, and even I myself struggled a lot because it's not very easy to teach. It's not something that is very familiar for everyone, right? It's like new. It's not like maths where everyone learns maths from, or English, for example, or any language, science. You learn that from primary school. However, accounting is something you chose to study, and it's something completely new. Now, so here we've got our first example, and in this example we're saying, let's say an owner of a business wants to invest £5,000 or dollars, whatever your currency is, into the business. So what this means is that, imagine you are the owner of a business and you've got £5,000, and you're like, okay, I want to put in £5,000 or dollars into the business so that we get more money to spend for the business. How are we going to record this, right? Now, what happens in this case is that we are increasing the bank, but you'll be like, what? But we are decreasing our money. Actually, accounting is only for the business. In accounting, the bank account of the business is increasing, right? So, and we know that assets from the previous video is anything that the business actually owns. So in the bank, any money that increases, it's actually good. It's an increase in asset. So that means we need to debit this this side of the bank account. As you see, the debit side is always on the left side, and we have to kind of write some sort of detail like, oh, this £5,000 came from an owner investment, and usually it comes with a date. Actually, it always have to come with a date, but I don't want to complicate it in the beginning. I just wanted you to see where it's happening. Not just that, I just couldn't be bothered to create a date at the top of my head, honestly. And then, because now we've done half of the work, because this is a double entry, right? We have debited the bank account. And as we were saying, so we have to credit the capital account, because we are saying now two things in the business is increasing. The bank account of the business is increasing, but also that money we're increasing in the bank account is now part of the capital of the business. So that is increasing as well. And now, last time I checked, whenever the capital is part of the equity, if it increases, then it is credited. So we have to credit capital as well. And that's good, because that means now assets increased, equity increased, the equation stays equal. Whenever you are in doubt, just go back to accounting equation. It's always the answer. All right. Now, so we always do this, okay, no matter what. And in the beginning, it's just weird and everything. I get it. So let's go to the second example. And in this example, we are saying that your business, for example, okay, we are saying you have made a purchase for office equipment by cash with £1,200 or dollars. All right. So what does that mean? Now, this is an expense for your business, all right? And expenses are not always bad. It's good because we need the business to work, and for it to work, you have to do some expenses here and there, right? Now, when an expense increases, all right, we say that it's an asset, because that means now your company has bought something very important for it to be working at its best. Now I know it kind of sounds weird, but this is how it is, right? It's more of like an expense, office equipment, and that's the reason we have it here on the side of the debit. So any expenses will be debited when increased. So, okay, we have, yeah, here we have to debit the office equipment as of this detail, cash purchase, $1,200 or pounds, and then we have to credit our cash because we are losing cash. The business is losing cash, but in the same time gaining some sort of expense for the future's benefit of the company. So we credit it in the cash section. Now, what this means in our accounting equation is that assets will not increase or decrease, because if we debit an expense account and credit cash account, that will just equal each other and cancel out each other. So sometimes you don't have to have something on both sides of the equation. One side of the equation can sometimes just be as enough. All right. Now this is our third and final example. So let's say you have a coffee shop as your business and you have to pay rent. Now this is so unrealistic. Obviously it's going to be way higher than that. But let's say your rent is £500 or dollars, and we want to account for this transaction because every transaction matters in accounting. Now, what is happening here? Now, rent is actually an expense, right? So the business is gaining an expense for the future of the business. For in the future, the business actually continues working, the cafe to continue work. Otherwise, you can't actually use the cafe. So we debit the rent expenses account, and we say that's £500 or dollars, and we put detail as bank. Okay, we are actually, because we don't have further details, we're just going to assume it's just bank these £500 were taken from. Alright, now we have to do the same thing on the other account, which is your bank account. Now here we've got decrease in money, right? A decrease in asset, which is just similar to the previous example, right? So we credit this account, and this way we balance our accounting equation. So it's actually not very complicated once you get into it, but also in the same time, remember, it does need practice. It's something completely new, not something you're usually taught in school. Thank you so much for watching the video, and have a lovely day.